Winning a client's business based on price creates an inevitable expiration date. When a competitor arrives with a lower quote, the relationship ends because it was built on a number rather than a solution. Most insurance agents rely on a method often called quote and hope. They take an employer's current data, shop it around the market, and wait for a lower rate, without analyzing the actual mechanics driving those costs. A slightly cheaper quote rarely solves the employer's problem. They are already aware that insurance is expensive. They need an explanation for those costs and a specific plan to reduce them. Traditional agents often lean on personal charm or favorable market timing. Technical advisors take a different approach, relying on definitive facts and procedural rules to manage the account. Carrying numbers from an insurance carrier to an employer makes the agent a replaceable commodity. This approach makes long-term client retention difficult, as a cheaper quote is always one phone call away. To move past the quoting cycle, we have to look at how these costs are structured. Rating bureaus process data based on rigid, strictly defined procedural rules, rather than subjective pricing. At the center is the CWCA worksheet. It takes payroll and claims data to calculate a single multiplier, the experience mod. This multiplier drives the final premium. As the mod scales, it moves total insurance costs in direct proportion. There is a structural flaw in this system. The rating bureau processes the data it receives without fact-checking it. If the initial data contains an error, the system generates a falsely inflated premium. Shopping for a new quote cannot fix a high premium if the underlying mathematical inputs on the worksheet are incorrect. The new carrier will simply apply their rate to the same flawed math. Consider a steel fabricator with 35 employees and an experience mod of 1.30. This suggests their risk is 30% higher than the industry average. Their current agent takes that 1.30 mod and shops it to different carriers, trying to find a better rate for the same high-risk score. It is a reactive strategy that accepts the 1.30 as a fact. A technical advisor approaches the situation differently. Instead of bringing a quote, they perform a forensic audit of the employer's existing CWCA worksheet to verify the data. The audit uncovers a procedural error, an improperly valued injury claim. Applying the correct rule fixes it. The bar shrinks, triggering a recalculation that drops the experience mod from 1.30 to 1.10, saving the employer $15,000 annually. The previous agent's quotes were built on unverified data. No matter how competitive the market rate was, the math behind the quote was wrong from the start. Uncovering hidden premium dollars shifts the dynamic of the relationship. By finding lost capital, the agent moves into a consulting role where their value is measured in recovered costs. This relationship relies on technical expertise instead of market timing. The advisor maintains the account by providing a blueprint of the employer's costs that competitors cannot replicate with a standard quote. This expertise changes the conversation. The agent can stop asking, "Can I give you a quote?" and start asking, "Have you performed a forensic audit of your experience mod?" A technical advisor provides the procedural knowledge an employer needs to protect their bottom line. They understand the rules of the system and how to apply them for the client's benefit. Gaining this advantage requires specific professional credentials, such as the Certified Work Comp Advisor, CWCA, and the Master Work Comp Advisor, MWCA designations. Insurance professionals can find training for these designations at workcompprofessionals.com. Employers looking for technical guidance can find resources at conquercompcosts.com. The strategy requires moving past the standard quote to analyze the actual math that controls the premium. It is the only way to move from a salesman to a consultant.